Hello. Can you hear me? Can you hear me? You can
Hi, I'm
Yeah.
here.
Okay, perfect, fine. I thought you weren't coming. I thought that you weren't gonna come.
We finished dinner 3 minutes ago, so it turns out I can be here. Oh,
Okay, thank you so much. You're like the main person giving me feedback, so I'm like obviously super
okay.
grateful that.
I will just lightly turn the camera off because I'm in a room
Yeah,
with
it's
limited
fine.
internet.
That's fine. Do whatever. That's fine. As long as you can hear me, that's all that matters.
Yeah.
Okay. Um. So I have, you know, how to explain myself. So over the weekend, I was quite happy to go. I went to Switzerland for the weekend, and I went to Rob's RV Capital annual meeting, and had a lot of discussions with a lot of investors, hedge funds, blah blah. Um, and there's a theme that kind of related this year that I didn't really, it wasn't really at the top of people's mind last year. um so I'm hoping that I've come back. I've got some stuff that I want to present to you guys and girls. So I'm going to talk for about 15 minutes, and then um I'm going to kind of open it up to some Q&A and see if people want to jump in with some questions of their own. Maybe they want to discuss something about the portfolio. Maybe they want to talk about the new pick, Arista Networks. If nobody jumps in with some questions, I've got some more stuff that I will kind of try to chat about. So the one thing that I've been going to Robert's meeting for a few years, and I don't know if it's like one of those things in life where you kind of just end up rubbing shoulders, and um, people have very similar portfolios or not. Um, so I don't know. But what I did notice on this time around is that a lot of people are attracted towards tech more so than I felt than in previous periods. Now, I think it's like human nature that we as investors are attracted to success stories, things that are working now inevitably um, get more capital sent towards them. And, this doesn't always work. There are significant risks towards having all your capital in tech. Tech right now is like it's working. Like everyone is making money. It's like it's not a big deal. Everyone's making money in tech right now. But I know from experience that tech doesn't always work. There are periods when things go out of favor, and you felt the portfolio was not you felt that the portfolio was diversified, but in actuality there was a lot of risks interlinked in the portfolio that you may not have been immediately aware of when you're building the portfolio. Now, um, I was very grateful. I had a very strong 2023, but whenever I come to these meetings, I always remind people that it never matters in the market how much money you make. The only thing that really matters is how much you keep. And I managed to make some strong movement forward, and I don't want to be in a position where next year or now in 2024 I am taking a step back. So I recognize that tech is working, but I don't want to have all my basket in tech. I own some of this uranium and stuff like that, and I own this tech resources. Obviously, uranium's working out, so no one's going to complain about that. But I own this tech resources. It's clearly underperforming the rest of the tech stocks. But I feel like, okay, you know, So Tech Resources is kind of like a copper company that diversified away the coal business. So they have approximately 10 billion of cash coming in this in next couple of quarters, and it's going to be just a copper business. So the copper long-term prospects are really strong, but near term it's not as strong. The business is highly profitable, but it's underperforming the tech. Now, I don't want to have everything just tech. I want to kind of have some a little bit of stuff that is not tech. It doesn't mean you don't need to be a hero, and you may prefer to, for example, have 20% in cash. That's cash is like oxygen. No one worries about it until it's gone, right? So I feel that cash is something that is so undervalued by investors. Everyone, when the market appetite is very strong, everyone only thinks about that upside potential. But when things are hitting the fan, which they will at some point, everyone's thinking about the downside. Everyone's thinking about balance sheet. Everyone's thinking about protecting how profitable the company is. So, the market swings and it goes from one point to another. And we don't, as investors, we are also predisposed towards that, and what we read, it tends to be what's working right now. So either on the downside or on the upside. So I feel that having some diversification is something that is really, really valuable and really, really important. I also just wrote some notes myself. So I want to be quite brutal. I already highlighted this last time, but I want to be quite brutal in this year in explaining to everyone, what my strategy is. So, in the past, when I've had stocks that are underperforming, I have tried to, because, when I own something, it's kind of like I've done the work and I believe in that outcome. But I don't know if you see it in this way, but in investing, it's an odds game. You, in my opinion, need to be over 50% of the time right to make a reasonable return. You can have some kind of, you can add some details to this. You can say you can just be 20% right, but as long as you make like a load of money on 20%, well, I have formulated. But this is an odds game. There's an element of probability. There's an element of luck that takes place. So there's a bit of skill and a bit of luck. And you are working hard to try to become more skillful to remove the element of luck. But, it kind of plays a role here. And when you do the work and you invest in something and the stock is not performing how you thought it was going to perform, it's inevitable that you kind of feel some of your ego being reflected in your portfolio. They say that your portfolio is an expression of your creativity. And you kind of feel like possessive over your ideas. And when they're not working, it's like, oh my gosh, like it's not working, but it's because other people don't realize the potential here, how undervalued this is. And it's, it's nonsense. And you need to kind of be quite brutal with yourself. That being said, I want to continue, which I believe is the only way to go about it. When I invest, I like to give these businesses a year to do their thing. The reason why I like to give them a year is because I am trying to buy a business that is going to be inflecting towards substantially more profitability in the next 18 months, a year and a half. So I'm trying to get that timing right. So I'm trying to get businesses that that I believe with a fairly strong degree of certainty that they're going to be more profitable next year. And if they're more profitable next year, the share price will, over that course of a year, move higher, because people will try, assuming the multiple remains relatively the same. Now, when I recommended Uranium Energy Corp in 2022, I recommended it at the height. It was like the highest point of 2022. And from the moment I recommend that stock, it fell 80%. And fast forward now, and that stock has now gone down the 80%, it's come back up, it's now showing a profit. But the holding period that I was holding that business, it caused a lot of mental distress. And this is something that when I was at RV Capital and Rob was discussing his investment in Carvana, and he was openly saying that that caused him a lot of mental anguish when Carvana at one point it sold off by I think it hit like 98% negative, like fell 98%. And as an investor, you don't want to put yourself in that position where you're suffering from distress. This is a long-term journey, and you need to align the portfolio in a way that allows you to live a long period of time. And to do this, to grow as a person, grow spiritually, grow mentally, grow as facets of your life. But you need that portfolio not to cause you to feel kind of emotionally drained. And so one part of me says, I'll give you the example of Uranium Energy Corp. I could have said something else, but sometimes you have these stocks that kind of you buy them and they sell off, and I don't want to be like, oh, it's down today, I'm out. But I don't want to be kind of continuing to deploy capital towards things that are not working, because whatever I thought, when I was describing before that I'm looking for that inflection in the business, whatever I thought when I bought the company, it didn't transpire to happen. So I had a hypothesis, I had a thesis, and that thesis didn't deliver, and I was wrong. And I need to kind of be quicker to think about that and to step back. The last topic that I wanted to kind of discuss is this idea. A lot of people like to kind of do different kind of strategies. Like they like to sell put options, and they like to kind of buy and like sell, and there's all kinds of different strategies people have. But those strategies, in my opinion, only give you the illusion of control in your portfolio. Let me just. So they only give you like the illusion of controlling your portfolio. Now, for example, let's say you bought a stock and you bought it at 5 and it goes up to 10. Now, just because the stock is at, let's say, $10 doesn't necessarily mean that it's overvalued. Because I was talking to an investor the weekend, and they're like, oh, I like to kind of buy a stock, and when it's got up 30%, I sell it because the stock is now overvalued. And I'm like, man, like, it's very difficult to know how a business is actually fairly valued. It's really, really difficult. There are some abnormalities, when it's like exceedingly overvalued, and there are some cases where it's really, really undervalued. But over the course of, let's say, 5-6 years, it can be, it's difficult to know. And what I'll say is, don't focus too much on, the price that you bought at. Like, think about a lot more of what the new investor next year is looking at the business and thinking. And just to conclude this, I believe that, so this is what I'm trying to work towards, okay? I right now, it's the end of the kind of calendar year. Many companies are reporting their Q4 results. Together with their Q4 results, they're going to provide their guidance for the next 12 months, particularly in tech, and commodities obviously not. But a lot of these companies are now going to be providing their outlook now. So obviously, a couple of things to keep in mind. First, the outlook will always be a little bit conservative, to leave them some space to, throughout the year, as it looks better and better, for them to increase their outlook. But at this point, it's kind of, people are still uncertain. There's still a lot of question marks. So there's a lot of volatility that's going to happen in the next throughout this earnings season that's now starting. But what I believe is a really attractive investment strategy is to buy businesses that are on the cusp of profitability, and that if you think about it, the market is always looking ahead by about 6 months. So if you're just trying to look ahead 12 months and the business, let's say, it's just for the sake of discussion, like something like Sentinel-1 is kind of, it's moving towards break even, and you just have a tiny bit longer time horizon than, let's say, 12 months, and you think, okay, in approximately 18 months or so, this business is going to be, let's say, at plus 1% profitability, or operating margin, sorry, at plus 1% operating margin. So you are buying into the stock now, and then in like a little bit over a year's time, this business turns profitable, and then that investor that comes in at the start of 2025, when they're looking at the business, they're looking at a business that still has considerable amount of growth, but it's a profitable business. And then all of a sudden, it's like, oh, there's no question about the economics of the business. It's really something that is exciting. It has growth and it's profitable, and people will pay a higher multiple on that type of investment. Now, for the sake of our discussion, which ties back to what I was saying about when I was at RV Capital, everyone is talking about the multiple, and the multiple that people are willing to pay on a stock can change very, very fast in a short period of time. If interest rates go up or down or whatever, in a very short period of time, the multiple can change, and it has this ability to trick you into believing that the business's prospects are either getting better or worse because the share price is going up or down because the multiple has changed. And I urge people not to think about that aspect. Think about whether the business is going to grow in profitability in the next year and a half. And sometimes, like I give you an example of Sentinel-1, but I could have talked about Gate Cloud Technologies. If the business is just becoming more profitable, the law of small numbers, it's relatively easy for the business to increase the profitability at quite a rapid rate. And if the business is also growing, let's say, in the ballpark of 30% compounded annual growth rates, you get some growth on the top line. And assuming that the profitability does come through, you will get, let's say, a 20-25% return on the holding the stock. Even if you exclude everything to do with the multiple either expanding or contracting. So that's kind of what I wanted to just briefly talk about. And if anyone kind of has any questions that they wanted to say or talk about, please ask now. Okay. If you want to ask a question, just feel free to ask. So one of the things that I'm trying my best to do, and this is tricky, but I'm trying my best to equally weight the positions in my portfolio. And the reason why I'm doing that is because, you kind of get attracted to businesses that on the surface look cheap, and you kind of attracted towards those businesses because you kind of start extrapolating, this business is going to be so attractive. But I have found that as a person, a lot of biases creep in, and a lot of emotions get attached to stocks, and you start kind of put in that position that you feel, okay, this is doing well, the management is saying this, and it looks great, and it's going to turn around or whatever, and you end up making that a larger position. And the problem is, if it doesn't transpire to be the case, that can become too large a position, and when that does at some point sell off, it kind of drags down the whole portfolio. And the market, the market's really good at understanding the quality of the business. Now, I'll give you an example. So Tesla is a highly contentious stock. And I was looking at, not because I was going to invest, but I was just kind of looking at Tesla. So, and I was really like put back that I could not imagine this. So I was looking at Tesla, and from the bottom of 2020, which is like just, what is that? Just 4 years ago, from the bottom of 2020 to now, that share price is up like 500%, and I was like, wow, that's complete madness. And this has been a contentious stock since since about 2011, and yet now here we are. It's like one of the top 5 companies. I don't really know per se, but 5 or 6 companies in the S&P 500, and the market called it. There's a lot of there was a lot of people saying, "Oh, it's overvalued." Like, I've been listening to this story about being overvalued for more, for so many years now, and yet here we are. So a lot of people kind of get really build their conviction on stocks, and we're kind of attracted to that, and we send capital over it, and we send more and more capital towards it. And on the other side of the equation is when you bought something and the share price is going down and down and down. And this is something that it's been in the back of my mind anyway. But when I heard Rob vocalize that when Carvana came all the way down on the share price, and he was buying more, but in hindsight, he kind of felt okay. He put more capital towards it than he should have. And if, like me, you're trying to compound, let's say 15%. You're a private investor. You have a lot of flexibility in what you buy, and you're trying to compound, let's say 15%. But what blows up the portfolio is those 1 or 2 positions that are performing badly but have too much capital behind it. The quality of the investor overall is okay, but when the person starts buying because they kind of feel that they're right, that can sometimes really take back quite a long period, 1 or 2 years of performance. And I just it's something that people were speaking about over the weekend, and I hope that I've been able to kind of put that across in a way that is helpful to you. Okay. And anyone else want to ask a question? I kind of feel like I've waffled a long time.
I just wanted to strongly endorse what you said about equal weighting of a portfolio. And I'm telling from a perspective of a guy who did not have equally weighted portfolio, and it didn't end that well. So I was, too committed to my top performing stocks that I couldn't see that they won't perform in the future. As you said, there were many biases. And when I have rather equally weighted portfolio, I feel even better about what's going on there. I do not feel dependent on one single stock or mood swings.
I agree. And when I started investing, I was always looking at what Warren and Charlie would say, and Joe Greenblatt, and these people like run a concentrated portfolio, and that George Soros quote, when you feel like you're right, go for the jugular. And I was like, oh yeah, this is the way to do it. And those individuals, they're extremely successful, but they're rare. They're anomalies. You don't need to be a hero in investing. And I'm a big believer in attempting to make things simple. And I'm a big believer in just, if you don't blow up, everything else is okay. You just cannot let yourself blow up. Even if, like, let's say, hypothetically, you're up 5% and the market is up 30%. That's okay. No one's going to die. It's fine. It's absolutely fine.
Yeah.
And just being a bit more kind of, as I was the weekend, it's like 95% men, and we are extremely risk seeking, and the 5% of the women is like a panel, and they were kind of talking about the quality of their ideas, and it just brings that home, that we are so aggressive, and we kind of feel like we got to prove something, but it's actually like over time, it's actually really, really good, even to get, let's say, 5 or 6%. It really is just like, it's like amazing. Uh, and I just like that concentration. It just, you have concentration in 1 year, and it kills you. Like if it doesn't work out, it just burns up your life. And
Yeah,
yeah, I feel that there's a lot of studies about the having an equally weighted portfolio. The only thing that I would say against having an equally weighted portfolio is that if you are in a position where your portfolio has, let's say, more than 40 companies, it's really difficult in that scenario to track 40
yeah,
companies. You end up just looking at the share price. You end up just, oh, the share price is doing this, but it's quite difficult to know how those 40 companies are performing. So
yeah.
anything around, let's say, 30 or a little bit less, I think that's okay. But having like more than 30 stocks in a portfolio, I think that is, I'm not sure if it adds a lot of diversification there.
I had 30 and it was too much. Now I have 18, 19, and that's okay.
Yeah.
And also, if I may, one thing, because it's the thing I like disproving, because I've read lots of articles like you do not need equally weighted portfolio. Warren Buffett has 4 top stock picks, which are 80% of his portfolio.
Mhm.
And I would like to give 3 arguments against. First of all, methodologically, it's not correct because Berkshire Hathaway, it's a conglomerate which has cash, own businesses, and stock portfolio. So stock portfolio is about 35%, depending on the year, of entire Berkshire.
Mhm.
People, when tend to analyze Warren Buffett, tend to forget the rest of Berkshire apart from his stocks. I
The
really
second
hate
thing,
it
I'll
because,
just very quickly, don't forget the rail is not a publicly listed company. I can't remember the name of the rail company that they own. So that's like,
yeah, 4 letter abbreviation. I don't remember
yeah.
which
So
one.
that's like a massive amount of the portfolio is right there as well. So yeah,
Yeah.
and
The
also the
second thing,
insurance businesses as well. They're not really
yeah,
publicly listed either. So there's a lot more diversification than just looking at the portfolio.
yeah,
They often say that, yeah, also they own a lot of bonds, which people don't really account for as well.
yeah. Second thing is, if we look at some institutional buying and selling, it's like Warren Buffett bought Apple, but there was a deal. It was not free market, purchase. It was something like, okay, he needed to buy this particular amount because of preferred shares, etc., etc. While you are not institutional investors, so you do not have this sort of, stuff here. And third thing, we talk about the outcome, and the first thing, when he started buying, it was completely different.
So
He
yeah,
just
I actually
bought it. Some stocks are top performers, and he doesn't that much need to sell it. And I think it's all that we need to remember when we review headlines like Warren Buffett has 80% of his stock portfolio in Coca-Cola, Apple, American Express, and whichever banks is fourth. So
and to add to that, as I was saying before, A, Warren is an anomaly. B,
yeah,
it's very, very important to be honest with yourself. And a lot of people get, when multiples are going one way or another, people kind of get deluded. And you need to be very, very honest with yourself and have a portfolio that reflects really who you actually are or attempting to be, rather than looking for those anomalies like the next Netflix or next Warren, and oh, that's how like I should invest, because that's really, really like, it's just fairy tales. It's people that write books about this kind of stuff. And I looked at somebody, it was some research from a few years ago, but it shows that even within Berkshire Hathaway, like something, I don't know, like from late 70s into the year 2000, there was a lot more churn in his portfolio than people were immediately realizing, because a lot of those positions were relatively small and they kind of churned in and out. So you know, people don't really kind of discuss that a lot, and I think that that's something that I believe is quite interesting.
Yeah, everyone remembers the quote, "My favoring holding period is forever," from Warren.
Mm-hmm.
But when he sees that the stock does not perform, or the underlying business, because that's the philosophy, does not perform, he's also merciless.
Yeah, for sure. Like countless examples I can tell you about, like IBM, and there was a British supermarket which was like called Tesco, which he owned and he sold because he was playing that Walmart thesis on it. Obviously the airlines. There's like loads of stuff. Didn't he? I think he actually sold also Gillette at some point as well. I mean, yeah, people say all kinds of things for, you know. Okay. If anyone wants to kind of use this time and ask any other questions, I'm very happy to discuss anything like within the portfolio, something that maybe what with Arista Networks, why I recommend that stock, or anything at all. And if not, yeah, we'll just call it here. Well, okay. Thank you so much for coming. I really appreciate your time. And I hope to see you guys soon. Thank you very much. Bye.